Hello and welcome to Panto Financial Services. This is Pranav Patil. Most of you have heard about, interest rates are going up in the economy. You must have read in the newspaper as well or in the media as well. You must have seen it. So have you thought about it, why it is happening? Is the recession really issue for India? It is not today or 6 months. Inflation is, issue for India is since long time. Then why it is happening, why the interest rates are going up? So today we will discuss why the interest rates are going up, and before that we will try to understand different concept in the financial regulatory, like who's the Fed, what is Fed rate, then who's the financial authority. These are the, what is the saving rate, what is the monetary policy, or what is the prime lending rate. These are the things we will first understand, and then you will get to know why exactly it is happening. So let's start with a simple example. Now, in the stock market, there is a regulatory, right? So every section or every sector has a regulatory authority. In the stock market, there is a SEBI, Securities Exchange Board of India, who regulate the entire stock market. In the US, it is a SEC. So similar way, in the financial markets or in the financial economy or the entire economy, there is a regulatory authority. In India, we have a RBI monetary policy or the RBI committee. A similar way, in the US, there's a Fed. Now, RBI and the Fed, there is a slight difference. RBI you perceive as a bank, but there is a committee also who takes the decision, different decision. That is called as a RBI committee, and the RBI bank is totally different. Now, in the United States, there is a Fed. Fed is called as a Federal Reserve System. It includes the 12 banks governor. How we have a one RBI in India to monitor all the financial banks. Similar way, in the United States, there are total 12 Federal Reserve banks are there who monitors all the private banks and all the financial institutions. And who manage this? Now, this 12 banks governor plus there are total 7 members are there in the committee, and the top level is president, that is Powell. He's the chairman of Fed committee. Now what happens? They decide the interest rate. On what basis they decide the interest rate? What is the interest rate? Interest rate is nothing but when you take a loan from a bank, banks charges you some interest, that is called as an interest rate. Or when you give a deposit to the bank, in return bank gives you interest, return as a return, that is called the interest rate. On what basis it is been decided? So we will try to understand. The major two factors drives the entire economy. One is the inflation and second is the interest rate. Now, inflation, what is the inflation and how the this financial regulatory? First we will understand the Fed, how they manage it. So I'll give you simple example. If you are Fed is a pilot and the economy is plane. So if the economy is slowing, the pilot, what the Fed does, they put the more money, they put they increase the cash in the market, and they try to increase the speed of that plane. Similar way, if the plane is going too fast, then the pilot comes and it reduce the speed by taking the money from the market. Now how it happens? First we will understand the Fed. So I told you there are total 12 Federal Reserve banks in the United States who actually monitors the all the private banks. Now, in the United States, every bank has to deposit some portion of their deposits with the Federal Reserve Bank. That is called as a Fed Reserve. And that the Fed Reserve, again, if anybody wants, they can take a raise of funds from the Federal Reserve banks as well. Now what happens? Suppose there is a bank and there is a B bank. B bank supposed to deposit $100, and A bank supposed to deposit the $100 with the Fed bank as per their deposit ratio, and the B bank supposed to deposit $120 as per their deposit ratio. Now what happens? A bank has only $90 with them, and this B bank has $130 with them. So to close the deficit, what A bank does, they take a money from the B bank and they give it to Federal Reserve to ensure to meet their regulatory compliance. Now, on what rate they borrow it? That is the mostly, or it is similar to the Fed rate. Now, on what basis Federal Reserve decide the rate? If you look at the history, in 1980, the Fed rate was 20%, and in 2020 it was 0%. Now, in the recently, you must have heard the news that 70 basis point has been increased by the Fed. So the current rate of Fed is 1.75. So when the bank borrows the money from one bank, or when the one bank borrows the money from another bank, they have to use as a benchmark as a Fed rate. So if these two banks do a transaction internally, they take a benchmark rate as a Fed rate. On that basis, they decided what rate we will borrow the money. That is the reason it is very important. Now what Fed does, before that we'll understand inflation. What is inflation? Inflation is how the economy is doing. It is the what is the price trend of the commodities or the regular products which you use it. Price trend of those products, it is upside or downside. Generally what is perceived in the economic, when the inflation goes up, that means there is a high level of demand, and that's the reason the economy is growing. The people have a purchasing power at the higher rate. If the product prices goes up, still they buy the product. That says they have a good amount of income. Now it is not only one factor you can see. You will have to see the different factors as well. So the Fed sees the other factors as well. What is the saving rate? In the United States, the saving rate currently, it is almost below 11%, while in India the saving rate is 28% plus. What is saving rate? Basically, if you earn 100 rupees, how much you save it? Average. So in India, if you earn 100 rupees, people tend to save somewhere around 28 rupees. Now, it is not necessarily you save it in the form of cash. It could be in the form of EMIs also, because it is getting asset, right? It is indirectly it is saving as well if you are buying a home. So this is called as a saving rate. So if the inflation is going up and the saving rates are not going up, then there is a problem. The some portion of the economy is going up only. So if we try to monitor this with the different parameters like CPI, consumer price index, or weighted price index, or wholesale price index, these are the different parameters. On that basis they try to monitor. They see for a 1 quarter or 2 quarter. If it is not controllable, what they do, they take action. There are two action Fed does. Either they put the money in the economy, either they withdraw the money from the economy. How they do it? Let's take example. Fed thinks that economy is not growing. So what they do? They put the money into market. How they do? They buy the securities from the market. So indirectly they buy it and they pump up the money into economy. This with the help of this 12 Federal Reserve Bank. Now, when they wanted to control the economy, if the economy is going too fast and actually it is not getting a benefit to the people, then they withdraw the money from the market. How they withdraw the money? They sell the securities. So indirectly, when they sell the securities, they they take the money from the market. Now, why this Fed is the pain for a global economy? What happens? There is something called as a prime lending rate. Prime lending rate is nothing but, suppose I am the bank XYZ, it is my bank, and I have a very decent client, or I have a very great particular client. So how will manage? I know this client is genuine, this client is not going to default. and I don't wanted to lose that client. So if they wanted to fund, I provide them at a very cheaper rate. On what basis I decide that rate? That rate is decided on the basis of Fed rate again. So one Fed rate is decided, one Fed rate is, decides lot of factors in the economy. So prime lending rate is nothing but the bank gives money to their prime customer. At what rate? That is called as a prime lending rate. Now what happens, suppose I am a financial company. I have a somewhere around $50 billion holdings with me, securities basically, and I see the Indian economy is going to go up very drastically in the next 1 or 2 years or 6 months. What I do, I take a money from the Fed, as in not directly Fed, but this banks in the US. What rate I'll get it, 1.7 or whatever the Fed rate is there. I take that money, I put into the Indian economy with the help of financial markets. Now, in the Indian economy, at what rate they will get the returns? Similar way, how you have the Fed rates in the United States, similar way RBI decides the interest rate in the Indian economy. So you must have heard about reverse repo rate, CRR rate. CRR rate is nothing but how much cash banks supposed to hold it with them. And the repo rate is like what rate the bank can do the transaction with a financial institution like RBI or any other banks. So on that basis, they decide the prime lending rate. Even when they wanted to take a money, they take the RBI rate as a benchmark. Suppose if I'm getting a money at 1.75, and in India interest rate are somewhere around 4.5%. So the costing is somewhere 25 basis point. I'll get the 2% return. This is the way it works. Now, assuming that this Fed increase the rate from 1.75 to 2% or 3%, what will happen? The cost of money, the cost of borrowing cost will go up. But my returns, will it go up? No. If they don't increase the rate, I will not invest into that economy. I will just simply take out my money from the Indian economy, because I'm not getting a good returns. It's better to keep the money with don't borrow it, let it be, because we are not going to get any profit out of it. So that's the reason RBI is supposed to come in the picture, and they are supposed to increase the rate to ensure the money doesn't go back. If the Fed increase the interest rate by 75 basis point, RBI before only or immediately RBI comes in the picture and they increase the interest rate, because there's a huge amount of money is India gets from this kind of transaction. So indirectly, the Indian economy gets a huge amount of money via Fed. And that's the reason if they increase the rate, they supposed to, Indian economy should provide the higher returns to them. Otherwise, they will go back. See, understand. Hope you got the point what I'm trying to make it. If Indian economy or the financial authority doesn't increase the rate, the money will go back and there will be a turmoil in the entire economy. That's the reason they have to increase the rate. If they increase the rate, by default it will hammer on all the products like a home loans or credit card loans or personal loans across, because the main interest rate has gone up or gone down. Accordingly, the impact happens. Hope I'm a bit clear. We will try to make it very simple. We have learned only two factors into this. First is the inflation. What is inflation? Inflation is a plane, and who's the pilot? The financial authority like a Fed or RBI is the pilot of that plane economy. Plane is the economy and the pilot is this Fed or RBI. They drive the economy. If the economy is going too fast, they will come and they reduce the speed via taking a money, and if the plane is too slow, they will come and they will put the more money and they will increase the speed of that plane. So this is how it works. try to understand this video, twice. Basically, sometimes what happens, if you are first time to understand this concept, it gets a bit difficult to absorb in a one go. And if you are in the financial market, and it is very simple trick, basically, if you properly understood. So in this video, we have tried to understand interest rate, why in India interest rates are going up, what is the prime lending rate, what is the saving rate, what is the how the financial authority puts the money into financial market. I'm not trying to make it more complicated by putting a lot of things. Hope you have enjoyed this discussion. Have a great day ahead. And if you have any comments, do mention in the comment box. We'll be glad to answer your points. Thank you so much. Have a great day.